Ever wonder how the rich keep getting richer? It's not magic, it's investing. Have you ever noticed how some people retire rich while others struggle? The biggest difference? Investing. Here's why investing in stocks is life-changing. Your money works for you. Instead of sitting in a bank losing value to inflation, the stock market has historically grown 8 to 10% per year. Way more than savings accounts. Even small investments add up. $100 invested monthly can turn into six figures over time. If you've ever said, "I wish I started earlier," the best time to start is now. How do stocks actually make you money? Most people think investing is just buy low, sell high. But that's only half the story. There are two main ways stocks make you money: capital gains, buy low, sell high. Example, you buy Apple stock at $100 per share. A few years later it's worth $200 per share, you just doubled your money. Dividends get paid just for holding stocks. Some companies pay you just for owning their stock. Example, if a company pays a 5% dividend and you invest $1,000, you get $50 per year, passively. The best part? Reinvesting dividends grows your wealth even faster. Want to retire early? A portfolio of dividend stocks can literally pay you to live. How to pick the right stocks. Not all stocks are created equal, so how do you pick the winners? 3 easy strategies. Invest in companies you understand. Ask yourself, would you still invest in this stock if the market was closed for 10 years? Good stocks survive crashes and thrive in the long run. Look for companies that make money. Check their profitability, net income, earnings per share, etc. If a company is losing billions every year, it's risky. Avoid hype stocks. If everyone is talking about a hot stock, it's often too late. Focus on long-term winners, not short-term hype. Bonus tip: use Yahoo Finance or Google Finance to check a company's financials before investing. Index funds versus individual stocks. Which one is better? Should you invest in individual stocks, or is there a safer option? Individual stocks, more risk, more reward. You pick your own stocks: Apple, Tesla, Microsoft, etc. If a stock booms, you make huge profits. If a stock crashes, you lose big. Index funds, safer and hands-off. Instead of picking stocks, you buy a basket of them, like the S&P 500. Less risk because you're investing in hundreds of companies at once. Historically, the S&P 500 grows 8 to 10% per year. If you want stress-free investing, go with index funds. If you like risk, mix both. How to actually start investing today. Okay, let's get practical. How do you actually buy your first stock? Step 1. Open a brokerage account, for free. Best platforms for beginners: Robinhood, US, easy to use. Webull, US, no commissions. eToro, global. Social investing, interactive brokers, global. Best for long-term investors. Step 2. Fund your account. You don't need thousands. $10 is enough to start. Many brokers offer fractional shares, so you can buy a piece of expensive stocks like Amazon or Tesla. Step 3. Choose your first investment. Go for strong, established companies: Apple, Google, Microsoft. Or start with an S&P 500 index fund, Vanguard VOO SPY. Step 4. Click buy and start investing. Set it and forget it. The longer you hold, the more you earn. Biggest mistakes beginners make: avoid these. Most beginners fail because they make these costly mistakes. Avoid these at all costs. Day trading, thinking you'll get rich quick. 95% of traders lose money. Investing based on hype. By the time you hear about a stock, it's too late. Panic selling during a crash market dips are temporary. Hold long-term, not diversifying. Never put all your money in one stock. The key to winning in investing: stay patient, invest regularly, and let compound interest do its job. By now you know how to start investing, how stocks make you money, and which strategies work best. But here's the thing. There's so much more to cover. If you really want to build wealth through investing, you need to go beyond just buying and holding stocks and start thinking about how to maximize returns while minimizing risk. Here are some next-level strategies that most beginners never hear about, but the pros use to make serious money. Dividend reinvestment, the secret to compounding wealth faster. Did you know there's a way to grow your investments without putting in extra money? It's called dividend reinvestment, often referred to as DRIP, and it's one of the fastest ways to build long-term wealth. How does it work? Instead of cashing out the dividends that companies pay you, you reinvest them back into buying more shares. Over time, this snowballs into bigger and bigger returns. Example, let's say you own 100 shares of a stock that pays a 5% dividend. Instead of withdrawing the dividend, you use it to buy more shares. The next time dividends are paid, you own more shares, so you get paid even more. This cycle keeps repeating, growing your wealth exponentially. Why is this so powerful? Because you're earning money on top of money, without doing anything. How to set it up? Most investing platforms like Robinhood, Webull, Vanguard, and Fidelity let you turn on dividend reinvestment for free. Just check your settings. Dollar cost averaging, the safest way to invest without fear. What if I told you that market crashes don't actually matter if you invest the right way? That's exactly what dollar cost averaging, often called DCA, does. It eliminates the fear of market drops. How does it work? Instead of trying to time the market, which no one can do perfectly, you invest a fixed amount of money regularly, no matter what the stock price is. This means you buy more shares when prices are low, and fewer shares when prices are high. Example. Let's say you invest $100 every month into an index fund. If the stock price is high, you buy fewer shares. If the stock price is low, you buy more shares. Why is this so powerful? Because you automatically take advantage of dips in the market. Instead of being afraid of crashes, you actually benefit from them. Best for beginners who don't want to worry about market timing, people who want consistent stress-free investing. The 80/20ths rule of investing, where to focus for maximum returns. Not all investments are created equal. In fact, most of your gains will come from a small number of investments. This is called the 80/20ths rule, or Pareto principle, and it applies to almost everything, including investing. How does it work? 80% of your investment gains will likely come from 20% of your best-performing stocks. This means that picking just a few great companies can be better than owning too many average ones. How to use this to your advantage? Instead of spreading yourself too thin, focus on high-quality investments. Look at your portfolio. Double down on the winners, cut the losers. Invest more into strong, proven companies, rather than chasing every new trend. Warren Buffett's Take Even Buffett follows this rule. Most of his wealth comes from just a few great investments like Apple and Coca-Cola. Focus on quality, not quantity. The power of ETFs, the easiest way to own the best stocks. Want to own the best companies without spending hours researching? Exchange-traded funds, or ETFs, are like a basket of stocks that let you invest in multiple companies at once. Why ETFs are great built-in diversification. You own pieces of many stocks, reducing risk. Lower risk than individual stocks. If one stock fails, it doesn't tank your whole portfolio. Super easy to manage, you can set it and forget it. Best ETFs for beginners. S&P 500 ETFs like VUO, SPY, and VTI track the 500 biggest US companies. Tech ETFs like QQQ and ARITK let you invest in Apple, Tesla, Microsoft, and more. Dividend ETFs like SCHD and VOM focus on companies that pay out cash regularly. The best part? ETFs make investing completely beginner-friendly. The ultimate investing hack, borrowing money to make money safely. What if you could invest with someone else's money without insane risk? That's what leverage investing is all about. But don't get it twisted. This is not about gambling. How does it work? Instead of only investing your own cash, you use a margin account or low-interest loans to invest more money. This allows you to increase returns faster without waiting years to save up. Example, let's say you have $5,000 in cash to invest. Instead of just investing $5,000, you borrow another $5,000 at 3% interest. You now have $10,000 invested instead of $5,000. If the market grows 10%, you make $1,000 instead of just $500. Why do rich people do this? They know the stock market grows on average 8 to 10% per year. If they borrow at 3 to 5% interest and invest at 10% returns, they make free money. It supercharges their wealth building. Warning: only use this strategy if you fully understand the risks. If the market crashes, you still owe money on the loan. Smart leverage can make you rich, but reckless leverage can wipe you out. Investing isn't about luck, it's about strategy. By now, you understand that investing isn't about guessing, it's about having the right approach. These extra strategies help you make your money work harder for you. Invest without fear of market crashes. Grow your wealth faster and smarter. If you're serious about building wealth, now is the time to take action. Now, let's get back to choosing the best investment strategy for you. Which investment strategy will you try first? If you're not investing, you're falling behind. The rich get richer because they invest their money instead of just saving it. Are you investing already, or are you just getting started? Drop a comment below. And if you want more no BS money strategies, hit that like button and subscribe to 3x3 Finance.